In a recent video, we covered why passive investing is superior to active investing. And in short, it's because even hedge funds on Wall Street tend to underperform the S&P 500 index. And so for most investors, the smart move is to just buy the S&P 500 index. However, index ETF investing is only one part of passive investing. And in fact, you could be an active investor even if you're investing in the S&P 500. And so today we're going to break down the passive part of passive investing, and we're going to cover a very important topic, which is called dollar cost averaging, or DCA for short. In today's video, we're going to cover what DCA is, why it works, how to start DCAing in your portfolio, and last but not least, I'm going to cover something that I think nobody is really talking about when it comes to dollar cost averaging, which is, in my opinion, the secret reason why dollar cost averaging truly works for people in practice. And so without further ado, let's dive in. What's up, everyone? This is Brandon from Wealth Potion, and today's video is actually in response to a question or conversation I was having with one of our wonderful subscribers. And so right off the bat, I want to give a shout out to my wonderful subscribers who either leave comments on YouTube here or reply to my emails on my email newsletter that also is named Wealth Potion, because the goal with my channel is to improve our financial education. And while of course part of education is just explaining concepts in simple and fun ways, another part of learning is participating in the conversation. So whether you're leaving comments, replying to emails, or sending these videos to other people that could learn from them, I really appreciate the two-way conversation. And so if you have questions, leave them in the comments below, send me an email, and I'd be happy to make a video on a topic if you're still not sure what it means. And that is exactly what we're covering today, because a subscriber reached out to me and said, hey, I've heard this term, dollar cost averaging, before, but I don't quite understand it. What is dollar cost averaging? In short, dollar cost averaging is when you buy into an asset at a fixed interval and a fixed amount of money over time. Let's say I had $10,000 I wanted to invest in Bitcoin. I could just go and buy $10,000 worth of Bitcoin right away, and that would get me something like 0.1 of a Bitcoin right now. However, if you were to do that, which is referred to as lump sum investing, what could happen is Bitcoin could drop 10% tomorrow because it's very volatile. And because I invested my full $10,000, that next day it's now worth $9,000. So it exposes you to more risk when you lump sum invest. Dollar cost averaging is a very different approach. It's where you say, hey, you know what? With my $10,000, I'm going to invest $1,000 every week on Monday, regardless of what the price of Bitcoin is. For this example, let's say Bitcoin is at around $100,000. If next Monday Bitcoin goes up to $150,000, I'm still gonna buy $1,000 worth. And if Bitcoin drops the next Monday to $70,000 per Bitcoin, I'm still gonna buy $1,000 worth. That is dollar cost averaging. And if we break down the expression itself, the dollar cost is the cost that you paid for that asset or for that stock. And the average is the average over time. So by buying in these intervals, regardless of what the price is, you are averaging your cost over that period of time. Now, why does dollar cost averaging work? The most important concept to understand here is how dollar cost averaging removes human emotion from the equation. Because if you have a methodical system for investing a fixed amount at a fixed date every interval, it doesn't matter how you're feeling that day. It doesn't matter if the price of Bitcoin skyrocketed and now I'm thinking, oh, well, maybe I should wait for it to come down. Or if the price tanks, oh shoot, maybe I'm wrong about Bitcoin. Maybe it's actually crashing. It doesn't matter. When you're dollar cost averaging, you're gonna buy the exact same amount on the exact same time period. And by the way, hopefully this is clear, but you don't have to do $1,000 every Monday. It could be $100 every day. It could be $20 every 5 hours. It could be $10,000 every month. It really doesn't matter. What matters is that it is the same amount every single time period, and the time period is also the same as you move forward. And again, the best way to understand this is to compare this to active investors or stock traders. What are they doing when they're actively investing? They are investing based on what they think or what they feel about the price of an asset. And I use the example of Bitcoin, not just because it's an asset that I believe in, but because Bitcoin is a very volatile asset. And when the price of Bitcoin goes way up to the moon, it becomes very clear, not just to Bitcoin investors, but just everyone, that there's a lot of emotion involved in that trade. We see news articles coming out about Bitcoin. We see it being talked about on CNBC, and everyone, including your uncle and your Uber driver, are talking about Bitcoin and crypto. That generally means that the sentiment is really strong and people are buying Bitcoin because everyone is excited about it. And conversely, when the price of Bitcoin is really, really low and it's in a bear market, nobody's talking about Bitcoin. And in fact, people are kind of dunking on Bitcoiners, saying, haha, told you that investment's not gonna work. And the whole point of dollar cost averaging is you're just removing all of that emotional noise. And so while I use Bitcoin as a more extreme example because it's easier to see, dollar cost averaging absolutely applies to stocks and even index ETFs. And so to bring this back to our recent video on passive investing, you could invest in index ETFs like the S&P 500, but you could still make the mistake of trying to actively invest, trying to time the market by saying, oh, you know what? Trump's tariffs just got into place. There's a lot of uncertainty around his presidency. Maybe I shouldn't buy this week. And then all of a sudden, the tariffs get reversed and voila, the S&P 500 is skyrocketing again. DCAing works so well because it removes your decision-making from the process. You set up a system and you stick with it no matter what. And so that brings us to how. How do you set up DCA? The easiest way to set up DCA is through your brokerage's mobile app. So whether you use Wealthsimple or Questrade in Canada or Robinhood or Interactive Brokers in the United States, or even just the brokerage app through your bank, there should be a functionality within the app where it allows you to automatically purchase an asset, such as a stock or an index ETF or Bitcoin, at a fixed amount every single time period. Now, not all brokerage apps have this feature, and if your brokerage doesn't offer this feature, that might be a reason to consider switching to other brokerage apps, because this is a very powerful feature. It allows you to fully automate DCAing. Instead of having to set a reminder in your calendar to log into your brokerage app every month or every week to buy the same amount, because by doing that manually, you are going to be tempted every Monday or every time period to think, should I skip this week? Or should I buy more this week? So the more you can automate, the better. And in fact, some brokerage apps will not just allow you to automate the purchasing of the stock or the asset, but you could even automate the deposit of money into your brokerage account. So just like for most people, when you have a full-time salary job, you're automatically getting your paycheck every 2 weeks or twice a month. You could set it up so that it's automatically taking money out of your bank account, depositing it into your brokerage account, and then buying the asset that you wish to DCA into. So you're automating not just the purchase, but the deposit of your cash. That would be the ideal DCA system. So if you can set that up between your bank account and your brokerage app, I highly recommend you do that. Now, as mentioned, if you don't have access to those features, maybe switch to a brokerage that allows you to do it. But worst case Ontario, what you can do is do this manually. So set up a calendar invite or a reminder in your phone every time period to purchase the same amount of a stock or asset during that time period. Last but not least, as promised, I want to touch on what I think is the most underrated reason why DCAing works so well. This might be obvious to some of you watching this, but I think it's not talked about by many finance content creators, and that is that if you have an asset that you are comfortable DCAing into, that implicitly means that you have utmost confidence in that asset class. Because again, to use the Bitcoin example, if Bitcoin were to drop tomorrow by 50%, there was some huge news about how Bitcoin was going to be banned in the United States, and literally the price dropped 50%. If I'm still comfortable with my DCAing program and I don't touch it, that means that I must believe in Bitcoin a heck of a lot more than someone that sees that price drop and goes and maybe tries to sell their Bitcoin or starts to panic. And so just by nature of you setting up DCAing, whether you do it with an S&P 500 index or with Bitcoin or a particular stock that you like Tesla or Nvidia, that means that you have to be confident enough in that asset to want to buy it when the stock plummets. In fact, you should be so confident in that asset that if the price drops by 50%, you are excited because that means you get to buy more with the same amount of money. And so to sum that up, DCAing doesn't just work because it removes human emotion from the equation. It does, but in order to pick an asset and then to say, I'm going to invest a set amount of my hard-earned money every week or every month into that asset class, regardless of the price, that means that you've done your research, and that means that you found an asset class that you are extremely confident in. And that in and of itself is why DCAing is so extremely valuable and why it will help you build your wealth much faster than people that are actively trading based on their emotions or based on the news media of that particular day. So hopefully this was helpful. As mentioned at the outset, please let me know if you have any other questions. I love covering these types of topics. As you can probably tell, I'm very passionate about personal finance and helping people build their wealth faster than the average way that our system wants us to. In order to do that, I'm gonna have to answer some uncomfortable or unpopular questions. DCAing isn't a particularly unpopular question, but I guess I'm saying that to invite you to ask any and all questions that are on your mind. There's no such thing as a bad question because we are all learning at our own pace. And oftentimes what the mainstream media or even big content creators will want you to believe might not be the best thing for your particular financial situation. So as always, I appreciate you if you've watched all the way through. If you like this video, like and subscribe or leave me some feedback in the comments, and I'll see you next time. Thanks.